Okay, well, it's after past, so I think we maybe ought to commence. Thank you for attending BHP's annual benchmarking report webinar for Academies. I'm Leslie Kendrew, I'm an audit partner at BHP, and alongside Philip Alsop and Mike Jackson, who isn't with us today, we specialise in providing audit services and advice to Academy trusts. I need to tell you that we're recording this webinar for our internal training purposes, but we can let you have a copy of the slides. If anyone wishes to have copies, just let me know. I'll Philip know. We do like it to be interactive, so if you can use the questions and answers Q&A tab at the bottom of the page or the chat function, I'll endeavour to interrupt Philip at the appropriate time. So this is the 11th year of the Kreston Academies benchmarking report. Kreston is a network of firms that BHP is part of. We're one of 7 audit firms in England within the Kreston group that specialise in academy trusts. And the reason why we started to produce this report was to provide some extra value to our clients. The first report wasn't much more than a pamphlet, but as we've taken on more clients and as the sector's evolved, the report has grown with it. The data in the report comes from BHP's clients of the Kreston firms, and for the first time this year, we've selected some of the largest multi-academy trusts where information was publicly available. Clearly the size of multi-academy trusts is growing and there are fewer and fewer single academy trusts. In fact, the number of SATs has reduced now to just over 1,300. Therefore, the structure of our report has shifted to have a lot more information on maths. Something else that's changed this year is that we now have 3 categories of MAT. Small, which is up to 3,000 pupils, medium, which is 3,000 to 7,000 pupils, and large, which is 7,000 pupils and more. This large category broadly ties in with the SFA's definition of a strong MAT. But our view is that you can have less than 7,000 pupils and still be a strong MAT, so we've tried to avoid that terminology throughout this webinar. Detailed tables of each of these 5 categories of trusts are included in the appendices at the back of the Academy's benchmarking report that hopefully you have recently received. We've also provided individual benchmarking sheets to each of BHP's external audit clients, comparing your data for August 22 with the average indices for the relevant category of trust. Happy to discuss these individually after the webinar. Please contact your usual BHP contact. The data from the August 22 accounts has been supplemented by a survey of Kreston Academy clients, so many thanks to any of you who have actually taken the time to respond to that. The background to this year's report has been a very unusual one. The academic year started with a lot of optimism, ended in a period of great uncertainty. Back in September 21, Gavin Williamson was Education Secretary, schools were back fully open and exams were scheduled for the summer. But by the end of August 22, we'd got the war in Ukraine, cost of living crisis, staff shortages, spiralling costs and blooming industrial action. So when we were discussing the August 22 audits and results with our clients back in October, November, there was a lot of nervousness about what the future would look like. The timing of the Teacher Pay Awards back in July 22, just a week before the budget forecast returns deadline, was not helpful and probably meant that the time that you'd spent producing the BFRs were undermined within an instant. The overall picture was one of great uncertainty for the future, and this was impacting on investment decisions of our trust clients. The next couple of years were expected to be very tough, but this was in contrast to the year to August 22 results that we had audited, and these are the numbers that we have obviously used within this benchmarking report. Most trusts we act for had a good financial year. We can barely think of any clients of ours that did not either make a surplus or a budgeted deficit. Very little evidence from the results for the financial struggle that you'd obviously all occurred during the year. What we saw was that the year started well, got progressively worse and more uncertain as it went on. And this is what the data shows, as Philip will now explain.
Thanks, Leslie, and good morning from me too. I'm aware from the attendance list that there's quite a few familiar faces on, watching this, and I know some people were very keen to hear what we've got to say this year. So hopefully, you'll find what we've got to say interesting. As Leslie said, please raise questions in the chat function, because it makes it a lot more interesting if we get a bit of a dialogue or discussion going. So just to start off with, this slide shows the number of trusts that are included in the data set. In aggregate, the number of trusts is a little higher this year due to the non-Kreston trusts that have been included, as Leslie's explained, but they've been excluded from this particular chart. The point I wanted to highlight on this slide was that the number of SATs and small MATs is falling, and the number of medium and large MATs is increasing. This is a trend we expected to see, but it's surprising how quickly this change is happening. Across the Kreston group, we've got nearly a quarter less primary SATs than last year, 10% less secondary SATs, but a 24% increase in the number of medium MATs and 70% more large MATs. And as a group, we expect the trend to continue in the current academic year. So moving on to the, getting started on the finances, this is a chart of the in-year surpluses. The first thing to quickly explain is, before we dive into detail, is how we look at financial performance. Academy accounts is quite complicated, so it's slightly difficult to work out what the financial result is in simple terms. What we've done is to look at the movement in free reserves, as we think that gives the most reliable measure to the in-year revenue surplus. So what we're doing there is looking at the movement in unrestricted funds, GAG funds, and designated funds. So the first headline from this table is that it's been another year with the sector making an overall financial surplus. The 2021 numbers were the largest surpluses we've ever seen, and so this year's not hit the same heights, but it's still a good set of numbers. So you'll see there's in-year surpluses across the board, except for primary SATs. This is the first in-year deficit we've seen in any category for the last 4 years, and we think there are two factors. Firstly, the increase in non-teaching staff pay with effect from April 2022 had a big impact on the 2022 accounts. You'll probably remember that we had to put in a provision for the back pay, and that, as I say, I know that had quite a big impact. Secondly, we can see from our survey that primary SATs, in our particular sample anyway, have been investing reserves in capital projects. So overall, it's been a very good financial year, and so we've now had 4 years of average in-year surpluses in a row. And the impact of this is that there are now less than 1% of the trusts in our data that have got negative free reserves, which is down from nearly 4% last year and over 8% in 2019. So I think this highlights the good financial management across the sector. By no means are all trusts making surpluses, but those that were in the 8% have clearly either taken steps to improve their financial position, or indeed some of them may well have lost their independence, and they've closed down. So we've ended up with a more solid sector, hopefully. So the 4 years of positive results and the good financial management has helped build up the reserves in the whole sector. But as the deficit for primary SAT shows, the financial position has got a bit tighter. And there's also some clear differences in the financial performance across the sector, as the table shows. Clearly, the primary sector shows the largest deterioration in financial performance, but there's deterioration in all categories. And you'll see that on average, the falls are fairly substantial, between 20 and 40%. Interestingly, it's the large MATs where the financial performance has held up best. You'll see that the number looks relatively consistent, and in fact is only 7% down on the prior year. Now, this could be due to the economies of scale and the spreading of risk in a larger organisation, and that would support the argument for larger MATs. We don't doubt this is a factor. But another factor, we think, is the way in which trusts receive capital funding, because the large MATs in the sample all receive SCA funding rather than SIF funding, and I'll explain those acronyms later. But it means they get regular capital funding, which makes it much easier to plan, estate management. So from a financial perspective, this avoids the peaks and troughs of SIF income and expenditure. And importantly, it also gives the larger MATs more control over their reserves. The SIF regime that applies to SATs and smaller MATs has been rewarding large contributions by trusts to capital projects. So many trusts have significantly dug into their reserves to help fund capital projects. And this impacts on their financial performance because the contributions are out of free reserves. So this movement in free reserves is highlighted in the next slide. So on this slide, the first graph shows the percentage and number of trusts that made an in-year deficit. The bars are the number of trusts making a deficit, and the line tracks the percentage. And the clear conclusion is that after more trusts are making deficits after a run of 3 years where this rate was declining. From our data, we can also see it's the SATs that have seen the largest falls in financial performance. And they've also seen large increase in capital expenditure per pupil, as you'll see on the chart on the right-hand side. So for primary SATs, average capital expenditure per pupil has increased by 62% from £228 to £369 a pupil. And for secondary SATs, average expenditure has increased by 74%. Obviously, these are very significant increases per pupil, and they far exceed the increase in capital income. So this highlights the significant, the sort of trend in capital expenditure highlights that there's been a catch-up basically in expenditure from prior years. Due to lockdowns, getting capital works done was very difficult, as you'll all know. So capital projects couldn't be completed. But as the economies reopened and some of the supply issues have been reduced, trusts have been able to get projects done. So the second issue is that a number of trusts have been actively reducing their reserves, which is a message we'll return to shortly. On the other hand, you'll see from the right-hand side of the right chart that MATs have had a more consistent level of capital spend and more consistent financial results as a direct consequence.
We do have a comment, Philip, that somebody's contributed that sort of saying, does bigger equate to financially more resilient? I assume it means bigger in size of number of schools within a trust, because the comment is you can more easily smooth varying pressures in academies. And I think that's right. The more schools you've got within your trust, you've got the economies of scale. And therefore, hopefully, you should be stronger and more resilient.
That's what you'd hope, isn't it? Obviously, as long as it's well managed, you're right. You can sort of team and ladle it between the schools, and you've obviously got the economies of scale anyway. So yeah, it should help. But yeah, size doesn't necessarily mean more resilience, does it? It depends on the level of reserves. I think we'll see a little bit more about that as we go on through this presentation, to be honest, which what we're showing. So, for example, in this particular slide, is looking at the percentage of loss-making trusts in 2022. So the previous slide showed that 26% of trusts made an in-year deficit. But you can see from this slide that it's not evenly split across the trusts. The primary SATs are the smallest trusts in the data, not surprisingly, and they show the highest number they've got making in-year deficit. So there's 47% made an in-year deficit in 2022, whereas the large MATs are the least likely to be showing an in-year deficit, only 14%. So the easy conclusion to draw is that the larger the trust, the more financially secure they are, which, interestingly enough, is what we've just been talking about.
Yeah.
So there's obviously some economic fundamental on that, but it's interesting, if you look at the other trusts in the middle of the chart, the view is perhaps challenged that it's interesting to see that the likelihood of being a loss-making trust is almost identical for a secondary SAT and small and medium trusts. For each of them, in our sample, 25% were making an in-year deficit. So although there's clearly a trend from the smallest to the largest trust, the position in the middle is more complicated. And it's arguable that being a smaller MAT doesn't provide much more resilient financial resilience than being a secondary SAT. Some of these smaller MATs are largely made by primary schools, which could have similar pupil numbers in total to a large secondary SAT, but obviously have to operate over a number of sites. So perhaps it's not at all surprising that the risk profile is not so dissimilar between a large secondary and a small MAT. The other way of looking at this is to say that primary MATs have a lower risk of recording an in-year deficit than a primary SAT, and so there is really a safety in numbers. So that's obviously another conclusion you could perhaps draw from these figures. So moving on, so the previous slide showed that the financial performance has been relatively strong, but that the performance hasn't been consistent across the sector. And we've explained why it's not been quite as good as in the prior year. However, overall, the financial results have still been very positive, and this has resulted in free reserves continuing to rise. This graph of free reserves shows a very small increase for primary SATs on the left-hand side, a £150,000 increase for secondary SATs, and then a very large increase for MATs. However, the increase for MAT reserves needs to be taken with some pinch of salt because it includes some very large MATs this year. But what the data does show is that there are some MATs with very large levels of reserves. I mean, to put these numbers into some kind of context, across the Kreston data set, the trusts have made an aggregate surplus of £116 million in 2022, and this increased aggregate free reserves to £764 million, which I think you'll agree is a pretty chunky number, and it equates to a reserve of £634 per pupil. And this data set includes about 25% of all the academy schools in England. So even on a basic extrapolation of the £750 million of reserves these trusts are holding, you can see that the academy sector as a whole has probably got several £billion of reserves. So it's no surprise, given the pressure on government spending, that the reserves are coming under some scrutiny. The difficulty, of course, is that reserves are not evenly spread across trusts. So some trusts are, as you'll all be aware, are much in a better position to cope with unfunded pay rises than others. Some are going to find it quite tough. So just continuing on the theme of free reserves, this chart shows the free reserves as a percentage of total income. And 11% of the trusts have more than 20% of income reserves. And in fact, the highest in the data had 42.5%, which is an enormous amount, isn't it? We've spoken in previous years about what's a sensible level of reserves for a trust. I mean, trusts are sort of like charities, and all charities should hold some level of reserves. It's the fundamental of good governance, but the level of reserves required is proportionate to the risks the charity faces. And compared to many charities, academy trusts are fairly predictable. Certainly the income is, generally fairly predictable. So the quantum of it, I know there's some variations on it, but the income stream is not going to dry up, is it? And so they can manage with relatively less reserves than perhaps a charity could. From our data, we can see that the majority of trusts have a policy of holding reserves equivalent to about 0.8% of annual income, which is about 1 month's worth of income or expenditure. On this graph, that's the big grey segment on the bottom right-hand corner. So here you can see that a significant proportion of the trusts are holding free reserves broadly, in line with the policy. But we have got 48% of trusts on the left-hand side of the chart that are holding reserves in excess of the policy. And there are 11% that are holding more than 20% of income as a reserve. And if reserves above this 20% threshold, it's starting to receive some scrutiny. Whether this is an excessive level of reserve really depends on what the trust intends to use the funds for. If the trust is planning to use them for a large capital project, as I'm aware a few clients are, or an investment in school improvement, and again, I've got a client that's planning to do that, then it's a sensible use of reserves. But if they've been held as an additional buffer against uncertainty, then it's going to be hard to justify. The largest reserve in the data was 42.5% of income, as mentioned previously, which really is quite a difficult one to explain, but no doubt there's a story behind that one. From conversation with our clients, most have got clear plans as to what they plan to spend the reserves on. More are getting better at designating funds and explaining to the public what these plans are. Many are also forecasting in-year deficits in the next few years as a result of cost increases. So they'll obviously bring the reserves down anyway. That's what reserves are for, is there for a rainy day, isn't it? For one person's reserves. And as mentioned previously, we've also seen examples of trusts actively spending the reserves to bring them in line with the policies. So we're not aware of ESFA taking any action against trusts with high level of reserves, but they're no doubt keeping an eye on it. And the threat that they might is having an impact on trusts and their investment decisions, we think. So I don't know if you've got any other comments before we move on. No?
No, we haven't, Philip, no.
I mean, the opposite side of reserves, or where the reserves are, is in cash. So this chart just shows you can get an idea where your cash balance sits compared with others. We tend to focus on reserves, but cash is also, important as well. So you'll see from this chart that for primary SATs, the cash balances have fallen slightly. For secondaries, it increased broadly in line with the in-year surplus. And for maths, it now stands an average of over £5 million. So, quite a substantial number. So this is sort of a forward-looking slide, really. As we said at the start of the session, Leslie was talking about it being an unusual year, and that it ended with a lot more caution and uncertainty than it started with. I think the sector, by the summer, the sector was moving from a position where you've got 4 years of surplus built up in balance sheets to one where the gains could be lost quite quickly. I think costs were starting to rise, and it created quite a lot of conservatism in the budgeting process, as this graph shows. So the 3 bars for each category of trust show the 2022 numbers, then the forecast reserves from the budget forecast returns. So the forecast returns are 23 and 24. So it's showing a sector that was expecting to balance its budget at the best. You can see there the primary SATs are showing a fairly level position. The secondaries are showing a fairly level position, and maths showing a bit of a dip, which I'll come to in a second. But we should also bear in mind that the figures on the charts were from BFRs that were submitted to the ESFA in July 2022. And as Leslie mentioned before, the full extent of pay rises wasn't fully known at that time. As I said just now, the intriguing trend in my mind here is the big expected reduction in free reserves in maths in 22-23. That big reduction from the black bar saying 3126 down to 2364. That reduction in free reserves is obviously an expected deficit. So this shows that when preparing the BFRs, the majority of maths were already predicting a big deficit for 22-23. So it appears they're rather planning to invest some of the reserves, or they're already feeling quite pessimistic about the future, even before the pay rises were announced. Obviously, the additional funding announced in November 2022 helps to close the gap, but it's going to be very hard for trusts to achieve a balanced budget given that all of the additional pressures. So although BFRs are normally pessimistic this year, it seems more likely that this pessimism is justified. It looks like it's going to be another tough year, doesn't it, really? Mm-hmm. So just turning briefly to the size of maths, the first chart shows that the average number of schools per mat in the survey has increased from 7.5 to 11, which sort of reflects the comments earlier. And the second chart is from a question in the survey about expected growth from people like yourselves, in academies. So you'll see from this that most trusts who responded said they expected to grow a growth of between 1 and 3 schools in each of the next 2 years. So, and that coincides with my sort of chatting to some of my clients as well. Obviously, some are expecting to grow a lot faster than that, but steady growth is often seen as the best way to go, really. So although the 2022 academic year was successful from a financial perspective, there are a number of other pressures in the sector. There's been a lot of discussion about cost increases, and I'll talk about those shortly. But there's also looming pressures on income as a result of demographic changes. So the data on this slide comes from government information and highlights the impact of falling birth rates. This fall is now starting to have an impact on primary schools. So you can see from this chart, the primary school population peaked in 2019 and has been falling ever since. And the government predicts that primary pupil numbers will fall by a further 532,000 from this year and will be 14% down on the peak. For an average sized primary school, this will be a reduction in GAG of just over £200,000 a year. We've already got nearly 47% of primary SAT showing in-year deficits, and most of the other 53% are showing small surpluses. So if you remove £200,000 of income from all the primary trusts this year, then only one trust in our data would have made a surplus, which is pretty scary, really. And another way of looking at this is to say that we would need 13% less primary schools across the country which is over 2,000 less primary schools. So there's some big changes in need that, will be needed. And I'm aware some trusts are already seeing demographic changes, shrinking pupil numbers and having to think about the viability of individual schools, which, another challenge for the primary sector in particular. Any comments at all, or shall I? If not,
no comments.
That's
No.
okay. Please do chip in.
Philip.
Thank you. That's fine. So these charts show the pattern of total income per pupil. So it shows that in primary SATs the number's gone up by 16%. In secondary SATs it's gone up by a much lower 2.3%. In MATs by 1.3%. So we need to bear in mind that the figures include capital income. And the average level of that in our sample increased very significantly for primary SATs, as you'll see in a later slide. There'll also be various other factors behind the trends. I mean, one example is that primary income per pupil is always lower than secondary income per pupil. And so the smaller rise in MATs may reflect that they've included an increasing number of primary schools. Obviously, the more you get primary schools in a MAT, the average level is going to go down, isn't it? So I think I think there's a definite trend towards secondaries almost converted first, didn't they, in a bigger ways, and there's more primaries catching up now. So I think that's definitely a valid comment. GAG income is the biggest component of school income, as I'm sure you all know, and that's risen on a per pupil basis by between 7 and 10%, depending on the academy type. And obviously that's a higher rate than the overall rate shown in the slide. It's partly as a result of the teachers' pay and pension grant being rolled into it with effect from 1st of April 2022. So that didn't change the overall, it was just a move from non-GAG into GAG itself. But October 21, the government did announce £4.7 billion of additional core funding for the sector, of which £1 billion related to the 21-22 year. So that's one of the other major contributors to the increase in GAG income. Sorry, skip slide. Obviously, one of the features of the last couple of years has been COVID funding or COVID lockdowns. So this chart shows the movements in training income and COVID income over the last 3 years. So what this is showing, you can probably take a bit of interpretation, but we've got the three groups as usual for primaries, secondaries and MATs. And then for each one, the first two columns in each one are 2020. So it's 2022 COVID income. And then the next column is 2020 trading, etc. So obviously in 2021, there's a significant level of COVID funding. And then obviously there was still some in 2022, but at a reduced level. But by comparison, trading income fell significantly in 2021 and recovered strongly in 2022. No surprise there. Obviously, the cost of living crisis and the current funding levels are leading trusts to look at ways of generating additional revenue to support financial sustainability. And you can see from this chart that MAT trading income shows particularly strong growth. Also, secondary SAT growth does as well, doesn't it? Can you see for MATs, the average trading income was 195, and that compares with 117 in the 2020 equivalent, which is the pre-pandemic pretty much, really, wasn't it? So there's quite a bit of growth there going on, isn't there? I mean, one example of growth that we've seen is more nurseries being opened. But some trusts are already also starting to collaborate with other organisations for the delivery of services in the community and in the social sphere, which complement the trust's core educational activities. And some things are also looking at other income generating activities which are related. I mean, these growth initiatives are all very positive and they're good for sustainability, but there is a risk that trading income may give rise to VAT or corporation tax implications. And we're advising a number of our trusts on this. So we're now going to have our first audience poll to assess your interest in a separate training webinar about VAT and corporation tax for academies.
Okay, so hopefully you can all see that. So we have in the past done a BHP, VAT and corporation tax update for academy clients. So would you be interested in an hour's high level update? Would you be interested in a half-day training session? Or would you not be interested in joining? And then we can feed this back to our tax teams. Oh, people are still voting, thank you. There has just been one question, which is what is trading income when you were analysing the difference between COVID and the trade mix? The trading income is income hiring of facilities, lettings, catering, recharging, and maybe recharging some of your actual staff to non-trust schools. So anything that is not providing education and actually using the GAG for the education of your own pupils. Okay, I think this has stopped, so hopefully you can all see that. We've got 81%. That doesn't actually add up, does it? But the majority of people will be interested in an hour's high level update.
I think that's probably shown us. I think, Leslie, that's probably shown us there's obviously a very strong interest in ours one.
Top line, yeah.
So maybe it would make sense to do that, and then
yes,
and then it's obviously a half-day training session is more a commitment for people, isn't it? And there's still half of the people will be interested in that. So
yes.
We'll take that away and have a think about it.
Obviously, it's worth doing. Thank you for that.
Yeah.
There we go.
Right. Yeah. Okay. No, thanks for taking part in that, folks. So moving on, next slide we're going to look at is capital income. It's been a bit of a mixed bag on the capital income for the sector this year, with primaries seemingly gaining while secondaries and maths see a reduction in funding. Before we get into any detail, we think it's worth setting out the distinction in funding types. Condition improvement funds, which funding which goes by the acronym of SIF, is funding for SATs and small maths. It's project specific and based on award by the ESFA after application by the trust. School condition allowance, that's SCA, is funding for maths with 5 or more schools and more than 3,000 pupils, and it's formula based. When looking at the graph on the left, it's evident from our data that primary SAT capital income per pupil has rocketed. As mentioned in the benchmarking report itself, this is due to a number of large value capital receipts for SATs within our data set this year. So we've produced a separate graph on the right, which has stripped out the outliers. By this we mean primaries with small pupil numbers and disproportionately large capital receipts. For example, there's a trust in the data set with 180 pupils that receives £780,000 of capital income. So you can imagine that distorts the, on a per pupil basis, that would be enormous, and it would distort the average. So you can see when we strip these outliers out, the data shows that capital income at primary SAT level, it's still increased slightly, but it's not much, it's much more comparable. An important thing to note about SIF funding is that since 2021, some of it's repayable funding rather than a grant. The SFA look upon applications more favourably if a trust agrees to either invest some of its own reserves alongside a SIF grant, or if it agrees for the SIF funding to be repayable over an extended period. The ones I've seen are repayable over 10 years, so I'm not sure whether that's a standard term or whether there's any variation in that. But SIF loans, from an accounting point of view, don't show as capital grants in the year of receipts because they sit in the balance sheet as a loan. However, the repayments will need to be met out of GAG, other funding or reserves as they arise. Now, you've got to meet the cash from somewhere, and that, as I say, won't come out of capital grants, it'll actually come out of, so it's got to come out of something else. So the trust is effectively committing some of its income or existing reserves for 10 years into the future. So it's essential that this is, you consider this when the funding is signed up, and also that it's reflected correctly in multi-year budgets. So this particular point is relevant to SATs and small maths, which are eligible for SIF funding. And this may be a partial explanation for the reduction in capital grants by secondary SATs and maths, as shown in this chart. So just moving on to the cost side of the equation, obviously energy costs is the a very topical issue everywhere, isn't it? There's been, obviously this is being well documented, and there's been various government initiatives to try and mitigate the impact of increases, such as the Energy Bills Relief Scheme, which has been benefiting schools, hasn't it? The Office for National Statistics data released recently shows that gas has increased in price by 129% and electricity by 67% in the year to January 23. And it's one of the main drivers of current inflation rates, which are currently in excess of 10%. But what has been the impact of energy prices increases on the sector so far? A review of our data on a school-by-school basis shows that energy costs for the sector increased by 26% on average. Within this, it shows that 57% of schools show an increase of 25% or less, and only 27% experience an increase of greater than 50%. So what does this data tell us? Given the scale of increases in prices that we just talked about, it probably suggests the worst is yet to come for the sector, I'm afraid. Part of our conversations with clients, it's clear that energy prices are a key concern for management and boards and regularly feature near the top of the risk registers. We know that a number of Kreston clients are still within their fixed price contracts. I think the latest fixed contract date that we're aware of is mid-2024. And these fixed term contracts give insulation against current energy prices and they're suppressing the impact on the sector as a whole so far. I know many of my trusts are part of the local authority buying groups, and there's likely to have been some fixed term contracts within the supply agreements that the buying groups have. So we would expect to see increases again through 2023, probably at a higher rate as more and more trusts come out of contract and move on to higher tariffs. So hence the comment that perhaps the worst is yet to come. I appreciate it sounds rather pessimistic, and trusts are obviously trying to be as creative as they can about how they buy energy, but there's only so much that trusts can do to impact the unit price. So it then comes down to how you use energy or don't use it. That's most likely to be the key to reducing your energy costs. So just moving on to the next slide. Trustee reports of larger trusts are required to include data on energy usage in the form of what's known as streamlined energy carbon reporting. This table shows figures for the last 2 years. All of the statistics you'll see show a reduction, and the average, which is obviously probably the most useful, shows a reduction of 14%. So that's obviously, clearly moving in the right direction, isn't it? I know that a number of my clients have been improving the energy efficiency of their buildings by installing more efficient boilers and energy efficient lighting. And, I'd encourage all trusts to start developing an energy efficiency or carbon reduction plan. The two obviously go hand in hand, don't they? And indeed, many have already started on this journey. And to assist with this, we ran a webinar in May 2022 called Beyond SECR, and we ran it with Auditel, a firm of cost and carbon management consultants. Some of you may well have joined us at that time, but if you weren't able to join it or you'd like a copy of the recording, please let us know, and we're very happy to provide it to you. Auditel are very well placed to assist you with energy procurement and developing carbon reduction plans, and also helping you put together the SECR data. Indeed, they're working with a few of our trusts already. So we'd be very happy to introduce you to them if that would be helpful. So if anybody has any comments on that before we move on?
No comments.
Okie doke. Well, the other big cost is salary costs, isn't it? So one of the highlights drawn out in the expenditure section of the benchmarking report is that average staff costs per pupil have remained flat at about 74% for primary SATs and for maths, and about 78% for secondary SATs. And we know that wages are the biggest cost of any trust, and a trust's ability to manage the payroll cost goes a long way to manage, the overall financial health. So we've had a look at the relationship between the two. So we've cut the data to see what the correlation is between the staff cost per pupil percentage And the two sort of profitability indices, the surplus deficit and carry forward per pupil. So the column on the left is the column for the academies with staff costs in excess of 78%. And the middle column is the ones with trusts with staff costs below 78%. And you can see that there's a clear correlation between the staff cost ratio and the surplus and carry forward figures. You know, the trusts with a ratio of less than 78%, those in the middle column, generate a surplus that's on average, which is 87% greater than those paying more than the 78% threshold. And they've got a carry forward reserves that's 70% greater than the ones in the, you know, the ones above the threshold. So, which is quite interesting, isn't it? I mean, it doesn't tell us anything that we weren't expecting or didn't know, but it is slightly surprising that 70% of the trusts within the Kreston data set are paying in excess of the average, you know, excess of 78%. There could be many logical or understandable reasons for this, or playing devil's advocate. It may be that some trusts have been doing just fine as they are, so have never had a reason to challenge the payroll costs in the way that many of the trusts have. But with the cost of living crisis, pay awards and other pay pressure in sharp focus at the moment, all trusts will come under pressure when it comes to total wage costs. And the benchmark of 78% will get you less staff than it has done historically. So keeping payroll costs under close scrutiny and ensuring there's no unexplainable fat in the staffing model is just as vital to financial sustainability of a trust as it ever was. Obviously, a key component of staff costs is teacher pay. So this chart shows the pattern of average gross teacher salary in our sample over the last 5 years. And you'll see that average teacher salaries have been relatively flat over the last few years. And I think one factor in that has been the replacement of older, higher paid teachers with more NQTs. But the 2022 statistics show an 8% increase in average teacher salaries in primary SATs and a 14% increase in secondary SATs. Maths show an increase of 8%, and that probably reflects the mix of primaries and secondary schools. So this slide shows an upward trend in average teacher salaries. I mean, I suppose that's to be expected given the government's strategy of increasing the salary of NQTs to £30,000. But it does highlight the pressure that you must all be under in terms of trying to balance the budget. So the other part of staff costs is supply costs. So we're going to have a quick look at that with this slide. The benchmarking report shows a movement in supply costs per pupil, and unsurprisingly, it's been going up. We've seen an increase of between 9 and 27%, depending on the trust type. So the question we as the Kreston Group pose ourselves is around supply costs is this down to recruitment issues or is it down to absence? And in reality, it's down to both. You know, I've had meetings with clients who've expressed the concern at the amount of sick leave they're experiencing, and others who've got concerns about the recruitment is the issue. So, one of the other Kreston firms did quite an interesting exercise, which I thought would be interesting to share, to look into the data around absences. They took the AAR data on sick days for 2021 and 2022 for a random sample of trusts across their client base, together with the full-time equivalent employee data. And their findings were as follows: that average sick days had increased by 24% in 2022 compared with 21, but the full-time staff numbers had only increased by 1%. And the average, also that the average FTE staff person was taking 12 sick days a year compared with 9 last year. I mean, the highest school rate in their sample was 21 days per person, compared with 20 at the same school the previous year. So that's a school with real problems, isn't it? I mean, it's difficult to compare sick days in the sector to what they might be in other sectors. But ONS data for absences for the entire workforce in 2021 showed there was an average of 4.6 sick days per worker. So it's indicative that absence is higher in this the education sector and the economy as a whole. Clearly, there are many mitigating factors, notably the mental health and burnout issues created by the pandemic and post-pandemic recovery. It's clear that increased sickness is a part of the reason for the increased supply costs, but the impact of staff churn can't be overlooked. You know, some clients do talk about a lot of staff churn as they've come out of lockdown. Perhaps more staff will start to think about moving jobs. It's obviously easy to say that, for me to sit here saying trusts need to make sure the working environment is optimum to ensure staff are attracted and retained. That's obviously a challenge that we as an organisation face as well, but it's not as straightforward an exercise when, obviously in your case, the elements of the job role and pay are outside your control, aren't they? So quite a challenge, really. So sticking with the salary theme, moving on to executive pay, this is always an area that's topical. Firstly, looking at CEOs in the graph on the left, the data shows that CEO salaries remain fairly flat at SAT level, primaries and secondaries, but have seen a 9.9% increase at MAT level. I mean, the sector's facing the challenge of showing pay restraint in tough economic times, while at the same time having challenges in attracting and retaining staff. However, we think it's positive that CEO salaries are starting to grow, as it will help attract aspirational individuals to the sector and to the role. And you can see from this that the average MAT CEO salary is 128,000. So that's the type of level it is. I know there's certain examples that are quite a bit higher than that.
Obviously be determined by the Ofsted reports, won't it? And schools in special measures will be looking to get certain types of CEOs in to be able to turn them around.
That's a good point, Leslie. Yeah, absolutely. Yeah. No, we all know it does. It's a tough job turning around, isn't it? But having said that, a few years ago, the DfE were quite keen on. They were writing letters out, weren't they, to trusts asking them to explain salaries of over £150,000. They've been relatively quiet on that front for a few years because of all the pressures of COVID that they know was being put on trusts. But I think in February 23, they signalled their intent to focus on CEOs who are earning, earnings are outliers. Obviously, they've got the data in annual accounts returns readily to hand. So there's been no indication of what their current approach to them will be, but it's clearly important that trustees are familiar with what the Academies Trust Handbook says about setting executive salaries. It's just important that you can demonstrate good governance and value and why you're paying the amount of salary you are, should the DfE come calling.
Yeah.
So turning to CFO salaries, these are showing an increase of between 5 and 15% increase. We know from discussions with clients that the CFO role is always a hard vacancy to fill. It's quite often long gaps between permanent appointment. There's obviously competition for accountants in different public sector roles and also in the private sector. And we're aware of big increases in salaries, amongst accountants, there is a shortage. So clearly, when you're recruiting into CFO, you are having to compete with people in other sectors. So I think in that context, the fact that CFO salaries are increasing again is a positive sign that trusts are working to attract the right candidates, because again we know you need a strong CFO to in a growing trust and in difficult environments. So I guess the onus is on a trust to be creative in how you can differentiate yourself to competitors to attract and retain good quality candidates, whatever the role is really.
I think as more trusts actually recruit qualified accountants in accordance with the ATH, that they're wanting to see more people have actually studied and not just come through qualified by experience, and I think that's going to increase even more.
I think you're right. That definitely seems to be the way it's going, doesn't it? Really. So the last few slides, I'm going to sort of have a look at central charges, because we're sort of aware that there's a lot of MATs in our data set. So it's one of the things that's key for MATs is how they charge the central services. You know, in a map that doesn't gag pool, the central cost note is probably up there with funds by school and staff remuneration notes. For, you know, users of accounts are quite often honing in on that, aren't they? And it's also a regular discussion topic with finance teams and trustees at MATs, partly because in a growing trust, it forms part of the sales pitch to attract new joiners. So there's a need to find the best way to present what your school, what your trust is offering, you know, what it represents. There's an interest in how does the central services charge compares with other trusts, and also is it value for money? So I mean, when you're looking at the accounts, the what's reported in the accounts, that there's no, obviously what a lot of people look at is the way in which the method used, and there's four methods that are in the model accounts, and those are the ones on the screen. The four methods are you know, percentage of income, amount per pupil, time apportionment, or other. And you can see from the data that the reported method in 2022 is dominated by the percentage basis of reporting, and 72% are using it as a percentage basis. And data from the past couple of years shows this hasn't really changed. It's been hovering around 70% of one pool maths amongst the Kreston clients for quite a few years. And I think our experience tells us that perhaps the use of the percentage is fixed to the association with the central charges or services by the LA, which we call the top slice, and it's quite often the phrase that's used for central services charges, you know, in discussions. And for growing MATs, this association matters, because for schools joining, they'll be either joining straight from a LA, or they might have been in a SAT where their only prior experience was an LA top slice. So it's sort of a words they're used to, you know, used to hearing, really, something they're used to understanding. But I suppose the question is whether the percentage, should the percentage matter? Should it be the first resort for reporting, or should it be a more service or value-based approach? You know, the other methods we're looking at here, like amount per pupil or time apportioned, are slightly more service or value-based approaches, aren't they? So is there an argument for using those, I suppose? This, obviously, the figure, what we've got on screen is what you call the reported method, as in what it says in the note in the accounts. I think rarely it's within a trust, it's quite as simple as picking an acceptable rate. As often as not, anecdotally, the percentage used is derived from the actual cost as a starting point, which is then adapted for presentation in the accounts. You know, what presentation is deemed to be acceptable to the trust or to schools in the trust or prospective joiners. The percentage-driven approach generally results in income in the central trust, which is either higher or lower than central costs. They rarely match up, so you either get a surplus or a deficit building up in the central trust. The surplus can be used to invest in individual schools, and some trusts set the rate for that very purpose. You know, they deliberately get more back from into the centre, and then they can perhaps do something to support the schools that need a bit more, you know, help. Obviously, a deficit is more problematic because it needs to be recouped from the schools and the trust in future years. Either way, it's obviously important for management and trustees to monitor the central charges position and to make strategic decisions about central charges and the reserves in the central pot. Just going back to the different methods of charging, you know, if a trustee's using the cost per pupil or time apportioned or other method, is arguably more sound, perhaps, because it perhaps more reflects the actual cost of supporting the individual schools. But it's perhaps harder to convey this when compared to the soundbite qualities of a percentage, particularly when key stakeholders are looking at this information, you know, and that's what they're focusing on. What's the percentage you're going to cost us? So perhaps this explains why we've seen so little shift in reported approach, even if methods are perhaps a bit more nuanced under the surface. So we can see that the reported method is quite static, but we can also look at the direction of travel within that. So looking at looking only at the percentage in this chart on the left-hand side, you can see a clear trend of increasing charges. You can see the 4% is dropping away completely, you know, quite a lot. 5% has dipped, 6 to 7% has increased quite a bit, hasn't it? So, and there's even more, some more in the 8% plus. So, so you can see a clear trend of increasing charges. So, I mean, this speaks to a sector-wide trend of MATs of increasing centralisation. I mean, and this is supported by our experience as advisors speaking with growing MATs that are looking to achieve greater operational efficiency. There's also a steady increase of MATs that pool and are therefore outside of the scope of this top slice percentage chart, and I'll come to that in a minute. Just sticking with the percentage thing, you know, we can see in the chart there's some that are in 8% plus. I suppose the question I'll leave open for discussion is, at what point does a percentage equate to pooling in all but name? You know, for the trust reporting in over 8% of income, what is left in local schools beyond frontline education provision that isn't being centrally delivered? I would, you know, suggest probably not too much really. Turning to the right-hand chart about pooling, this chart covers all trusts that were pooling either income or reserves or both. There's a bit of a, sometimes it goes under the phrase gag pooling, but that's just, that just is there's obviously a lot more nuances to it than that, and some trusts, more trusts I'm aware of, are more concerned with pooling reserves than actually pooling income and then allocating it, you know, in a more bespoke way. But basically the chart shows that 23% of MATs in the Kreston sample were undertaking some form of pooling. I mean, the experience amongst the BHP client base is quite a bit lower than that level at present, but the trend is, of the last 5 years, you know, he's clearly moving towards more that sort of direction, isn't it? So we thought it'd be interesting to run another audience poll just to assess the audience to this webinars, what your position is on the pooling of income and reserves. So over to Leslie.
Yeah, sorry, I'm just wondering if I can find it.
The ones to Zoom.
It's still showing the VAT and the tax update poll, unfortunately. Bear with me. Here we go. Okay.
Ah, far away.
So the question is, please, for answering, is your trust already pooling income, already pooling reserves, considering either of the above, or not yet considering? I'll just give you time to respond. Okay, let me share the results. So the larger number are actually not yet considering it. A third are considering one or the other, and a third are pooling reserves, which is what you suggested there, fully, wasn't it? That people, although we use the phrase gag pooling, it's not actually income that's being pooled.
There's more interesting reserves, isn't it? Yeah, they are allowing I think what that means is that they're allowing obviously GAG is allocated to schools individually, isn't it? And they're allowing the DFE allocation of GAG to prevail, but just pulling the reserves into the centre. And yeah, that's perfectly fine, and it makes sense, doesn't it? But it's interesting to see that, isn't it?
It is, and I'm certainly having more conversations with clients about pooling, and people are considering it, so that probably is a fair representation of my clients.
Yeah, I mean, if you are thinking of starting to pool, then please have a chat with us. It's certainly if you're starting to pool income, it's sort of important to have a pooling policy really, that for the trust that is transparent, so people know what's happening, and schools joining the trust are aware of what will happen to their reserves. So it's important to develop. So you need something that's forward-looking and you aware of, you know, that. So you don't end up with problems further down the line. Really, it's always better to be open and transparent, isn't it? Really.
Yeah.
Yeah. Thanks, Leslie.
Thank you.
So on to the last couple of slides. So thanks for bearing with us. So thinking about the other two questions, how does your MAT compare to others? Is it value for money? We now try to dive into some of the detail below a sector level to see if anything more meaningful can be taken from available data. 5% of income remains the largest segment of reported central charges, at about 50%, but what does 5% actually pay for? So as a Kreston group, we reviewed a sample of 10 medium-sized MATs amongst our clients, reporting 5% as their method. And just as a reminder, medium is 3,000 to 7,500 pupils. And from this, we reviewed the information included in the accounts note, the annual accounts return, and the benchmark data. And the list of what is included on the screen won't surprise anyone. And it represents a framework of services you might expect to be provided in some way by a moderate to fully centralised trust. The first thing to say is that beyond the value of the charges per school, there's little to work with to then establish how much of that cost pays for each type of service. Financial data collection tools and accounts look at types of costs at quite a high level, broadly staffing, property and administrative costs that tie into the total expenditure notes in the accounts. So this restricts the ability to then match it with the narrative. There's also the consideration of where each trust chooses to process expenditure between cost centres, and that's a matter of internal policy and discretion. What we can look at is the types of services being provided, so that's what we've got on the screen. And if we now take a look at how many of this particular 10 trusts report each area as being part of their central services, we start to reach the limits of reasonable interpretation of the data. You can see from this screen that what this is showing is that all 10 showed finance as being part of the central charge, but at varying level. The incidence of other words in the note varies quite a lot, doesn't it? So there's a lot of variation in narrative across this sample of 10. And picking out a couple of areas, finance and HR and payroll both report almost universally as central. But what does that actually mean? Does finance mean a fully centralised accounts team, or a CFO with an individual finance officers and school business managers reporting into them from each school, or something in between them with accounting hub leaders? None of the sample gave any detail, but with the advantage of a bit of insider audit information, we can confirm that the group is a fairly healthy mix of all approaches. And looking at premises, all 10 of the trusts are SCA MATs, so should be managing the capital expenditure on a central basis, but only 8 of these trusts actually reported any degree of central approach to premises management. As with finance and HR, it's difficult to tell how much lies between, how much of that activity lies between the centre and the schools in each case. There's also interpretation of terminology. Is leadership or school improvement implicit or explicit in central services provision? Has the trust actually thought to mention it, or do they just assume that it's inevitable, really? For example, only half of the trust stated that leadership was provided, although all 10 included the SLT cost in central costs. Governance has got a similar trend. A MAT should have governance driven down from the trustees through key leadership, but only 6 trusts reported as part of the central costs. I think we're here thinking about the cost of supporting governance. If we cut the data instead across leadership and governance together to make them interchangeable, we've still got only 8 out of 10 trusts covered. So, there's no suggestion here that any of the trusts have got problems with the services provided, or that the financial reporting is in any way inadequate. It just highlights the effect of discretion that's afforded by narrative reporting format, doesn't it, when it's reporting on financial data. So what's the conclusions on central services charge? Where does it leave us? I think we can see that the data is useful for broad trends in the sector. We can see a direction of travel and commonality of reported approach. And this can give a trust individually some assurance on their position within the sector, and a reference point for plotting, your individual trust progress in growth and centralisations. Percentages statistically dominate the are the dominant feature in financial reporting and discussions with key stakeholders. But underneath the trends, it's sometimes a challenging picture to interpret. So unlike other areas, we've looked at in this session, looking at the central charters is qualitative rather than quantitative area of financial reporting. And the data we've got lacks narrative context, so it's difficult to draw strong conclusions from it, really. So how can trusts have confidence in the value that their central services provide? We know trust leaders want more detail to help the benchmark, but there's also got to be a balance with the burdens of having to report it. And there's always a trade-off, isn't there? The more is required to report, the more effort it is for CFOs, for example. So I think it just illustrates that benchmarking is an important and powerful tool in the right context, but in situations like this, it needs to be supplemented with qualitative measures and discussions. So that brings me to the end of the presentation, which hopefully you found helpful. So over to you for the audience for further questions.
Thank you, Philip. That was really interesting. Hopefully everybody's got something they can take away. Thank you to the people that did ask questions. There were no extra questions at the end. Excuse me. If anybody does have anything that they'd rather just deal with personally, please just contact your usual BHP person or myself or Philip after this session. And when we close the session, you should hopefully get invited to do a quick survey. Hopefully it'll only take 2 minutes, but it will help us for future webinars just to let us know where you want us to focus on. So thank you, everybody. And if there's no further questions, we'll let you all carry on and have a good day. Thank you. Bye-bye.
Goodbye from me as well. Thanks for attending.